Hello, 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 and welcome back to yet another live event where we unpack passive investing in apartments, multifamily, underwriting, and due diligence one step at a time. So, today I want to share with you some of my key takeaways from the IMN Family Office Real Estate Conference. Pretty large event, and there's a lot to unpack. So I will try to be concise and to the point, but there's a lot more that I can share with you. But before I dive in, for those who may be tuning in for the first time and perhaps do not know me, my name is Vessi Kapulian, former commercial lender turned real estate investor and entrepreneur. And today I work with people in a couple of ways. One is advisory capacity, whereby I work with family offices and their family enterprises, advising on strategic initiatives, due diligence on investments, next gen transitions. Of course, for busy professionals looking to diversify their portfolios and create additional income streams and tax deferral efficiencies. I help connect them with well vetted cash flowing investments in apartments. And last but not least, for those willing to do a deeper dive and actually learn how to underwrite and vet deals, I have a community that also comes with a self-paced course where I help investors new to the space accomplish just that. And along those lines, I recently published a book, Mastering Multifamily Underwriting: 5 Steps to Confident, Risk Smart Apartment Investing. It is right here. That is now an Amazon bestseller, so you can claim your copy today if underwriting vetting deals is on your horizon, and perhaps investing in yourself is one of your new year resolutions. So without further ado, I want to dive in and cover a few key areas. So that was a 2.5 practically 3 day event, 2 half days and 1 full day, packed with panels, networking. There were 1,000 plus participants in the event, probably more. And it's definitely one that I found extremely interesting. The participants represented a variety of groups. There were operators in real estate, there were family offices who focus on real estate, there were funds and institutional level capital allocators. There were some who straddled both sides on the allocation side and operation side, and of course, a ton of service providers when it comes to accounting and CPA services, legal, AI, investment portals, you name it. Basically, a lot of the ancillary strategic partners that are connected to real estate. And so I share that with you because what I appreciated about the audience is the variety of perspectives that definitely came through in the conversations as well as in the panels. So here are some of my key takeaways. Capital is there, but it is hesitant and conditional, or maybe I would even say even more deliberate, focused, and intentional. From the debt markets, the credit appetite seemed to be coming back based on feedback from a variety of lenders, lending partners, as well as operators. But at the end of the day, and as I shared multiple times during live events and in my content, the lender's ability, right, to allocate proceeds is really contingent on the cash flow of the property, among other factors, operator, market, and such being other determining factors. So that still is in the current environment, that's maybe 50 to 65% of the capital coming into a deal, which still is a pretty sizable tranche to be filled in by limited partners and passive investors, whether that's large funds, institutional investors, or other form of capital. And so, um, in the past couple of years, it's no secret, right, that real estate has underperformed, which has done a couple of things. One has pushed people away from real estate, and many are looking at the S&P 500 and what the stock market has done, and has continued to grow. So that's one factor. Another factor is that there are a lot of allocators, right, have capital that is tied up in existing deals. Some were supposed to exit, but we all heard about the pretend and extend activity that has been happening over the past couple of years. So deals that were supposed to be exited are now getting extended. So capital is still tied up in those deals. And in some unfortunate cases, and that was mentioned several times throughout the conference, there has also been a loss of capital. So when you layer that on top of people being more cautious about that, or maybe being attracted by other asset classes or other types of alternatives, that has created a few constraints. It has definitely made capital raising more challenging. Even what I appreciated in terms of facts and stories shared across different panels is that even experienced investors with the track record, seeded portfolios, and such from start to finish, several participants mentioned it's taking about 24 months in the current environment to complete the allocations and close the fund. And what I just shared has been a big function why. Secondly, the uh, real estate in general historically has been attractive to family offices and a lot of investors for the tax deferral benefits alongside with cash flow. But in the current market environment, and I've spoken at length about it around the top line compression as it relates to rent growth, physical and economic um, vacancy, as well as affordability. And then on the expense side, right, and I've spoken at length about it as well, effectively that's resulting in compression of NOI and cash flow compression. And if you have other unexpected events that you have to take care of, it's not unusual for many of those deals and funds to pause distributions or even initiate capital calls. A long story short, all that to say is that the cash flow has been pretty much non-existent, and so that's also causing a lot of institutional investors and family offices to take a step back and consider, well, what are my other options? And many have actually shifted to VC and private equity, which naturally come with the yield component and more patient approach, not as much cash flow. That is another factor that has maybe diverted, if you will, some of the capital flows from commercial real estate to those other asset classes. Um, how people are winning today, it's really focusing on niche markets, perhaps markets and sub-markets that are away from the mainstream. There's definitely been renewed focus on fundamentals and truly diving into and understanding what the true value add is for this investment, and is there a value add, because that has also come under pressure. And I did an article not too long ago, as well as a post around the ROI component, right? Like, a lot of people talk about value add, but what does that really mean? And as an investor, an operator, right, you want to ensure that it is accretive and not dilutive to the business plan. So people are really peeling the onion to its core. Another common theme or thread was that sponsors or allocators rather are retreating back or flocking back to sponsors who are experienced, who have the track record, and maybe less willing to negotiate, right, when it comes to fees and terms. But one of the participants even said, you get what you pay for with perhaps some of the emerging and new fund managers. So really focusing on not only on the fee structure, not only on the fees, but also on the structure of the deal and making sure it's fair for all, but also confirming that the sponsor alignment is there and it's not all centered around the fees where maybe they collect a substantial part of it up front. Implementing a variety of performance tracking metrics. So one common example that kept getting brought up across various panels is the alleged construction management fee, and that I was speaking near and dear to my heart, right? Because if they are cost overruns over budget, does the team really earn that fee? Especially in the current market environment where there is an opportunity to budget that safety net up front. We all know about the labor market recent immigration policy that has impacted labor, both labor availability, labor costs, which impacts not only the cost component but timelines. We all know about the tariffs and the impact on materials, and copper has been in the news lately and will probably continue to be so. So there are a lot of factors, of course, that one cannot anticipate up front, but staying abreast of news and weaving in that information in your forecast to ensure that you're presenting realistic numbers and not optimistic numbers that look good on paper. So that's another theme that came through when it comes to structure and fees, but also really digging in to understand what is the value add and are these numbers realistic? Is the yield going to come from optimism or truly vetted numbers and not necessarily cap rate compression? And that was another theme that was brought up, and again, something I really appreciated because as I've shared on prior live events and in my content, of course a lot of it depends on person's outlook or an operator's outlook and where they think the market will be. But I think there was a pretty good consensus across participants. And again, these are people at the institutional levels that we are in a higher for longer type of environment. So they're structuring deals and underwriting deals as such to mitigate the risk. And last but not least, when it comes to capital allocation, because of all the factors that I shared, a lot of participants, that's family offices, funds, passive and other passive investors, are retrenching back to deal specific deals, especially if it's a unique deal that truly can stand on its own, versus allocating into blind pool funds and looking at a more diversified portfolio. So, and they're looking at situations where they not only have the control, but can really drill into the specific assets to determine how the deal is structured, whether it's properly underwritten, whether it fits a unique space in their portfolio that they're perhaps looking to allocate capital towards. And that seems to be happening more smoothly and more easily on a deal by deal basis. In some cases, their family offices are joining hands as well to perhaps start joint ventures and relationships with capital allocators. But again, the focus is on having that visibility and control on a deal specific basis. And last but not least, one theme that I've spoken about many times is communication. That manifested itself in a couple of panels, both the LP panel and then the lender panel, and both parties emphasize the importance of it. And when I say communication, that's ongoing, open, and transparent communication. Someone mentioned an interesting stat that for their company, I was a commercial retail operator, that about 50% of LPs open their updates until distribution stop, and then all of a sudden you get engagement. But in many cases where some maybe friction may occur is if those communications are non-existent or if distress comes in as a surprise. So many emphasize the importance of communicating early, communicating often, and communicating openly. And especially when it comes to the lender or the credit side of the markets, and those allocating on the debt side of the capital structure, emphasize that even more, not only from a communication flow perspective, but also an opportunity for all parties to come to the table and proactively think through a solution, and being ready, willing, and able to work with those who can perhaps allocate additional capital to a deal and have executed, have that history of performance. In cases where that's absent and when layered along with minimal or no communication is where you see deals getting foreclosed on and getting into distress. And last but not least, it wouldn't be an event these days if there was no talk about AI. That was certainly a topic, and the emphasis there, of course, AI is here to stay. I think we can all agree on that, but a lot of people feel overwhelmed in terms of where to start or how to start. So, one piece of advice that resonated with me is taking a step back, evaluating holistically the business, and finding one area, starting with one area where the processes can be perhaps automated and improved versus trying to think of anything and everything that you can plug AI into, which often can lead to overwhelm. And secondly, making sure that you teach people how to use it. Not everyone knows how to use it. And one of the participants used the analogy of giving the keys to a car to someone who's never driven a car before and expecting them to figure it out and perform. So equipping employees with the tools and resources, and making sure that they have the education before just rolling it out to ensure successful adoption and implementation. So there's a lot more that I can share with you, but I thought I would pop in today and share some of those key takeaways that stood out for me. I'll be writing a more in-depth piece on the topic in the coming weeks, so definitely check it out in my uh, family office brief newsletter. But until then, I wish you a wonderful week ahead. Usually I pop up on Thursday afternoons, but I do have a couple of trips and travel coming up, so I'm having to change the schedule to uh, Tuesday afternoons, Wednesday afternoons to fulfill my commitment to you on a weekly basis. And of course, you're always welcome to connect one on one to discuss and follow up on anything that I shared with you today. Also, if you need a second set of eyes on a deal or facing a capital call situation, I've helped many investors with evaluating those situations and making an informed decision. And like I mentioned at the beginning, if investing in your education is on your list for 2026, I will happily share with you the link to my published book, which has now become an Amazon bestseller, Mastering Multifamily Underwriting: 5 Steps to Confident, Risk Smart Apartment Investing. I wish you a beautiful day. Until next week. Ciao.